Welcome back to the Deep Dive. It is Tuesday, February 10th, 2026.
Hard to believe we are already, almost through the first quarter of the year?
It really is. Time just flies when the markets are moving this fast.
It absolutely does.
And today we are doing something a little different. We are essentially stepping into a time machine. Well, not really, but we're dissecting a company that feels like it has gone through, a decade of evolution in just a few short years.
You're talking about Robinhood.
We are talking about Robinhood.
Yeah, it has been quite the journey for them. I mean, if you look at the entire timeline of modern fintech, Robinhood's story, its arc is probably the most dramatic one out there.
Absolutely. From the Sheriff of Nottingham accusations back during the meme stock era to where they fit today, it's night and day.
Completely. And I think for a lot of people, that name, Robinhood, still brings up those very specific, almost chaotic images from 2021.
It does. You think of GameStop, AMC, Dogecoin.
The digital confetti falling on your screen when you made a trade.
Exactly.
Yeah.
It felt less like a sophisticated brokerage and, more like a casino you could carry around in your pocket.
Right. It was all about gamification. But looking at the stack of research on my desk today, the 10Ks, the analyst notes, the deep value reports, that whole narrative, entire story, just feels ancient.
It does. It feels like a lifetime ago in financial years.
The company we're looking at today bears almost no resemblance to that 2021 startup. I mean, the DNA is still there, sure, but the maturity level is.
Yeah.
It's a completely different organism.
Exactly, because today, in early 2026, we are not looking at some scrappy startup fighting for its life or answering to Congress about gamification.
No.
We're looking at a profitable $77 billion fintech giant. But here's the tension, and this is really the core conflict we're going to unpack today.
This is the big question.
Is this new Robinhood the Apple of finance? A tech platform that deserves a massive premium valuation because it has solved the user experience puzzle? Or is it just a cyclical brokerage in disguise that is, for now, renting a moat through some pretty unsustainable subsidies?
That is the multi-billion-dollar question, isn't it? And it's fascinating because the market itself seems really, really torn right now.
How so?
Well, you have growth investors on one side who see a super app that's going to dominate the next 20 years. And then on the other side, you have value investors who are just screaming that it's priced for perfection.
Trading at multiples that make no sense for a financial stock.
Exactly. They're looking at it saying, this is a bank. Why is it priced like a software company?
And before we get into the weeds of the numbers, and we have some really wild numbers to cover today, from the 2025 earnings report to the death cross that just formed on the charts, I want to mention a tool.
Okay.
It can really help you track the temperature of the broader market if you're trying to understand valuations like the one we're discussing today, or just want a sense of whether the market is, overheating.
Which is always a good thing to know.
It is. You should search for and download the iOS app Buffett Indicator from the Apple App Store.
It's a great resource. Simple, but very powerful.
It really is. It gives you that 10,000-foot view of where the total market stands relative to GDP. You really can't analyze a stock like Robinhood in a vacuum. You have to know if the tide is high or low.
Context is everything. Absolutely.
Okay, so let's set the scene. Today, Robinhood stock, ticker HOOD, is trading right around $85.60.
And it's been a rough couple of weeks for them. Very volatile.
It has. We've got some technical signals flashing red, which we will absolutely get to later in our deep dive. But the mission right now is to strip away the story, strip away the narrative, and just look at the cold, hard facts from the fiscal year 2025 earnings.
And those facts, they tell a very, very specific story of metamorphosis.
It's that right there. Section 1, the metamorphosis. If you just look at a chart of their profitability, it looks like a hockey stick. It just goes straight up. But explain to me, and to our listeners who might just see that headline, how real is this turnaround? Because, accounting can be creative sometimes.
It's very real. And to appreciate the magnitude, you really have to remember the hole they were crawling out of. In 2021, Robinhood posted a net loss of $3.7 billion.
$3.7 billion.
Yeah.
That is a staggering amount of money to lose. That's more than the GDP of some small countries.
It was a black hole. They were bleeding cash. It was the absolute definition of growth at all costs, fueled by massive stock-based compensation and just a chaotic market environment.
Right. They were hiring thousands of support staff just to answer tickets about why people couldn't buy GameStop.
Exactly. Now, fast forward to the fiscal year we just closed, 2025. They posted a net income of $1.9 billion.
So that's what, a swing of over $5 billion to the bottom line?
It's a $5.5 billion swing. It's not just an improvement, it is a complete structural overhaul of the entire business model.
That is massive.
Yeah.
And the top line, the revenue, that jumped too, right?
Oh, yeah. Total net revenue for 2025 hit $4.5 billion. That's up 52% year over year.
52%.
And that's not small scale growth. That is massive scaling for a company this size. When you see 50% growth on a base of, $3 billion, that tells you something fundamental has shifted in the demand for your product.
Okay, so I have to play the skeptic here for a minute. They're making money hand over fist now. But how? I mean, did everyone just start day trading 5 times as much?
Yeah.
Did the meme frenzy come back and we all just missed it?
No.
Because usually for a brokerage, profit comes when people are over trading.
And that's the key misunderstanding. If you think Robinhood's profit comes from people trading Dogecoin, you're looking at the 2021 model. The pivot, the real genius here, was toward net interest income, or NII. That combined with just extreme cost discipline.
NII. Let's define that for everyone, because it sounds like some sort of banker jargon, but it's actually the secret sauce here, isn't it?
It is the secret sauce, but it's actually pretty simple. NII is just the difference between the interest a company earns on its assets like cash it holds at the Fed and the interest it pays out to its customers on their deposits.
So Robinhood is sitting on billions and billions of dollars of user cash in their accounts.
Exactly. And when interest rates are high, like they have been, Robinhood takes all that uninvested cash, they park it in safe government securities or overnight facilities, and they earn, let's say, 5%.
And what do they pay the user?
Well, they might pay the user 4%, maybe less, or in some cases, nothing at all if they aren't a gold member. And they keep the difference. That spread is almost pure profit.
So they basically became a bank.
Essentially, yes. They diversified their revenue streams, so now they aren't just making money when you click buy or sell. They are making money 24/7 on the cash just sitting in your account, on margin loans, on securities lending.
And that's where the cost discipline comes in.
That's the other half of the equation. They managed to get their adjusted EBITDA margins up to around 75%.
75%?
Yeah.
That's unheard of in traditional finance. That sounds like a software company margin.
Exactly. Goldman Sachs or JP Morgan, they don't have margins like that. They can't. They have physical branches, thousands of employees, legacy mainframe computers from the 1980s, layers and layers of middle management.
Whereas Robinhood is just code.
Robinhood is code. They are running incredibly lean. They replaced a lot of their support staff with AI chatbots. They automated compliance checks. They're operating with the efficiency of a SaaS company, but they have the revenue model of a bank. It's a potent combination.
So they've got the margins of a tech company and the revenue streams of a bank. I guess that explains the massive cash pile. I see the phrase fortress balance sheet here in our notes.
Yeah, that's a term Jamie Dimon usually reserves for JP Morgan, but you know what? Robinhood has kind of earned it. They are sitting on $5.4 billion in corporate cash.
$5.4 billion.
And here's the kicker. Their debt-to-equity ratio is just 0.08.
8. That is basically zero debt.
For a company of this size, it is incredibly low. Most fintechs, most growth companies, they leverage up. They take on debt to fuel their expansion.
But Robinhood didn't.
They didn't.
Yeah.
And this matters so much because it gives them options. It gives them flexibility. When you have that much cash on hand and no debt service weighing you down, you can survive any market downturn. You can weather a crypto winter where trading volumes just dry up.
But more importantly,
you can fund incredibly aggressive incentives to go out and steal customers from your competitors.
Steal is a strong word, but in finance, it really is a zero-sum game, isn't it? If I move my account to Robinhood, Charles Schwab loses an account.
It's a war for assets. And right now, cash is the ammunition.
We're definitely going to talk about those incentives, or bribes, as the bears might call them, in a little bit. But I want to touch on the users first. Back in the day, the big knock on Robinhood was that it was just kids with, $50 accounts trying to get rich quick on meme stocks.
Right.
Has that actually changed, or is that just marketing spin from the company?
The data says it has changed, and changed drastically. We really need to stop looking at just active users, which can be a vanity metric, and start looking at wallet share.
Okay, so what's the key metric there?
The metric to watch is ARPU, average revenue per user. In 2021, at the peak of the mania, that number was around $65.
65, okay.
In the fourth quarter of 2025, it hit $191.
Wow. Okay, so the users they have today are nearly 3 times more valuable than the users they had back then.
Exactly. And the average account size is now around $12,000. That's up from $4,000. Now, 12 grand might not sound like a lot compared to a private banking client at Morgan Stanley, but for a mass market retail brokerage, that is a very, very healthy number. It shows they're shedding those tiny inactive accounts. In fact, in 2025, they went through a process called escheatment.
Escheatment? That sounds like a medieval torture device.
Yeah.
What is that in plain English?
It's a regulatory term. Basically, if an account sits dormant for a certain number of years, usually 3 to 5, the state can claim it as abandoned property.
So Robinhood just hands over the account.
They turned over about 460,000 inactive, low-balance accounts to various state governments.
That's a lot of users to lose, 500,000 people.
Yeah.
The headline must have looked terrible.
The headline number looks bad, yeah, losing 500,000 users. But strategically, it was brilliant. It was pruning the dead weight.
How so?
Think about it. A user with $5 in their account who hasn't logged in since the Dogecoin crash of 2021 still costs you money. You have to pay for server space, for compliance checks, you have to send them tax documents, you have to handle support tickets if they ever do log in.
They're a cost center, not a profit center.
Exactly. By escheating those accounts, they just cleaned up the entire user base. They got rid of the liabilities, and now they can focus on the people who are actually bringing in 6 or 7 figures.
So they're actively trading quantity for quality.
Precisely. And it's working. They're successfully attracting serious money now. This isn't just for play money anymore. For a growing number of people, it's becoming their primary financial home. The person who opened an account to buy 1 share of AMC is now using Robinhood for their IRA, their credit card, and their high-yield savings.
Okay, so that's the financial foundation. They're profitable, they are cash rich, and their users are richer. Now let's get into the bull case. This is the argument that Robinhood isn't just a better brokerage, it's becoming the Apple of finance.
This is the super app thesis. The whole idea is that you have one single app on your phone for everything. Banking, trading, crypto, spending, retirement, you name it. And the engine driving all of this is their subscription model, Robinhood Gold.
I see they have 4.2 million members on Gold now. That's a lot of recurring revenue.
It is, and think about what that means. These are people paying a monthly fee just to be part of the ecosystem. That creates recurring revenue, which Wall Street absolutely loves because it's predictable.
Unlike trading fees.
Exactly. Trading fees go up and down with market volatility. Subscription fees are steady. If the market crashes tomorrow, those 4.2 million people are very likely still going to pay their subscription fee next month.
But the real genius, or the real danger, depending on your point of view, is how sticky they've made it.
That's the key, the sticky factor.
So what keeps people paying that subscription? Why don't they just leave and go to Fidelity or Vanguard, where there are no monthly fees for basic accounts?
There are 2 main anchors holding people in right now. First, the Gold Card. They have 3 million active users on their credit card.
The one with the metal design.
That's the one. And it's really disrupting the industry because it offers a flat rate cashback, 3% across the board in some categories, that is just very, very hard for traditional banks like Chase or Amex to compete with without destroying their own margins.
Everyone loves flat rate cashback. It's simple. You don't have to think about calculating points or these rotating categories like gas stations in July or drugstores in October.
It is simple, and simplicity is Robinhood's entire brand. But the second factor, this is the real golden handcuffs, the retirement match.
Ah, yes, the famous 3% match. This has been all over their ads.
It has. So if you transfer your IRA, your individual retirement account to Robinhood, and you're a Gold member, they give you a 3% match on that money. But, and this is a big crucial but,
There's a catch.
you have to keep the money there for 5 years.
5 years. So if I move $100,000 over, they just give me $3,000 for free,
Yeah.
but I'm essentially locked in for half a decade.
Essentially, yes.
Yeah.
It's a brilliant retention tool. It's why their assets under custody, or AUC, just hit $324 billion.
Wow.
They are literally paying people to bring their life savings over. And think about the friction involved. Moving a retirement account is a headache. There's paperwork, transfer fees, waiting periods.
It's a pain.
It's a huge pain. Once that money is there and you've got that 3% bonus vesting, you are not going to move it out again for a small reason. It creates incredible incredible stickiness. It transforms a transactional relationship into a long-term marriage.
So they're locking people in, but they're also launching new stuff constantly. I feel like every week I see a headline about a new Robinhood feature. Is this just feature creep, or is there a real strategy here?
It's product velocity, and it's a huge part of the bull case. They are strategically trying to shed that image that they're only for newbies. They launched Robinhood Legend, for example, which is a high-powered desktop platform.
Finally. The desktop users have been begging for that for years.
Yeah.
I mean, the mobile app is great for checking a price, but if you're doing serious technical analysis, you need a keyboard and mouse. You need screen real estate.
Of course. Serious traders want multiple screens, they want dense charts, they want data. Robinhood Legend gives them that. And it stops the advanced traders from graduating to a platform like Interactive Brokers or Thingiaswim.
So they used to lose their best customers once those customers got too good for the app.
Exactly. Now they have a place for them to stay. And then there's Cortex, their AI research assistant.
Is that actually useful, or is it just another gimmick? I feel like everyone is just slapping AI on their product and calling it a revolution. Here's your AI toaster.
It's a fair skepticism, but from what I've seen, Cortex is designed to democratize the kind of analysis that hedge funds have been using for years. It's not just buy this, sell that. It's more like summarize the sentiment on the stock from the last 50 news articles, or find me companies with this specific growth profile and low debt.
So it keeps users on the platform.
That's the goal. If you have to leave the Robinhood app to go to Google or Yahoo Finance, they lose your attention. Cortex is designed to keep the entire research workflow inside their walled garden.
And then there are the prediction markets. I've been seeing a lot about this, the partnership with Kalshi, right?
Yes, this is fascinating. In 2025, Robinhood users traded 8.5 billion event contracts.
8.5 billion?
Yeah.
That's wild.
It is massive volume. And you have to remember, prediction markets are uncorrelated with the stock market. You can bet on election outcomes, sports results, economic indicators.
So even if the S&P 500 is flat or crashing, people will still want to bet on who wins the Super Bowl or what the Fed's next move is.
Precisely. It opens up a completely new revenue stream that doesn't care if we're in a bull or bear market for stocks. It's almost recession-proof entertainment, and it's another reason to open the app every day.
Okay, so they have the subscription model, the retirement lock-in, the pro-level tools, and now these betting markets. If you look at this through the lens of a growth investor, like a Peter Lynch or a Stan Druckenmiller type, how do they see Hood?
They classify it as a classic fast grower, and the key metric they'd point to is the PEG ratio, price earnings to growth, which is under 1.0.
Let's pause on the PEG ratio for a second. Define that for us.
Sure. The PE ratio, price to earnings, tells you how expensive a stock is relative to its current earnings. But that doesn't account for how fast those earnings are growing.
So a company with a high PE might actually be cheap if its earnings are doubling every year.
Exactly. The PEG ratio divides the PE by the earnings growth rate. And typically, anything under 1.0 is considered cheap for a growth stock. It means the growth rate is actually outpacing the premium you're paying for the stock.
So despite the stock price going up so much, the underlying growth is rising even faster.
Correct. And they have this massive demographic tailwind behind them, the great wealth transfer.
We hear this term a lot. Break it down.
Trillions of dollars are set to move from the baby boomer generation to millennials and Gen Z over the next decade as inheritances are paid out. And guess who the #1 brokerage choice is for Gen Z and millennials?
Robinhood.
It's Robinhood. By a landslide. So the bull case logic is you don't even need to acquire new customers. You just need to wait for your existing customers to inherit money.
They're sitting in the front row for the biggest movement of capital in modern history.
That's the thesis. When grandma leaves her portfolio to her grandson, he isn't going to keep it at the dusty old bank she used. He's going to move it to the app he already uses every day.
Plus, they're going global now.
Right. The Bitstamp acquisition, the expansion into the UK and the EU, over 15% of their revenue is now international. Their stated goal is 50%. So the growth story is pretty clear. We have the young people, we have the best tech, and we're taking this model to the rest of the world.
It sounds perfect. It sounds like a slam dunk. Why wouldn't everyone just buy this stock at $85?
Well, hold your horses, because now we have to flip the coin and look at the bear case. And the bears have some very, very sharp claws.
Okay, so let's play devil's advocate. If it's growing this fast, if everything looks this good, why the hesitation, what's the problem?
One word, valuation.
But you just said the PEG ratio is good.
The PEG ratio is good if you believe that 50% growth will last forever.
Yeah.
But if you look at a different metric, the price-to-book ratio, it's sitting at roughly 9.0.
9 times book value. Okay, for context. What do traditional banks and brokerages trade at?
Charles Schwab, JP Morgan, Morgan Stanley. They usually trade at 1 to 2 times book value. Maybe 3 times if they're really crushing it and growing fast.
So Robinhood is trading at 4 or 5 times the valuation of its more established peers.
Correct. The market is pricing H-Hood like it's a software monopoly, like a Salesforce or a Microsoft, not like a financial firm.
And the bears would argue.
The bears argue that money is a commodity. $1 at Robinhood is the same as $1 at Fidelity. You shouldn't be paying a 9 times premium for a checking account just because the app has a nicer user interface. If that growth slows down even a little bit, that multiple of 9 has a long, long way to fall.
That brings us to this rent-a-moat theory. I love this phrase, but it's kind of damning.
It's the most critical analysis of their whole strategy. We talked about that 3% IRA match as a brilliant retention tool from the bull perspective.
Right.
The bears look at that exact same thing and say, that's not a brand advantage, that's a bribe.
Meaning, people are only there because you are actively paying them to be there.
Exactly. There's a great quote from one of the bear analyst reports. Mercenary capital moves for the highest bidder.
That's good.
It is. The question is, if Robinhood stops paying that 3% match, or if a competitor like Webull or SoFi comes out and offers 3.5%, do those customers stay loyal to the Robinhood brand? Or do they leave?
If they leave for an extra 0.5%, then you never really had a moat in the first place. You were just renting those customers with your shareholders' capital.
Precisely. You are buying loyalty, not earning it. And that gets very expensive, very fast. It forces you into a race to the bottom where you have to keep spending more and more just to stand still.
That is a scary thought. Because if the loyalty is purely transactional, then those amazing 75% margins we celebrated earlier might just be temporary.
And that links directly to the Goldilocks earnings risk. We mentioned that a huge chunk of their profit now comes from net interest income interest on customer cash. Right now, interest rates are around 3.5% to 3.75%. That's a perfect Goldilocks zone for them. It's high enough to make really good money on cash, but not so high that it crashes the economy.
But the Fed is always a wild card.
Always. If the economy slows down and the Fed has to cut rates significantly, say back down to 2% or even 1%, that free money profit from NII just it evaporates.
And it falls straight off the bottom line.
Immediately. And if your earnings drop because rates drop, that PE multiple of 36 could skyrocket or the stock price could crash to adjust. They are incredibly sensitive to macro factors that are completely outside of their control. They are effectively a big bet on interest rates staying relatively high.
And then there's the governance stuff. This always seems to pop up with these big tech founder companies.
It does. For one, they have a dual-class share structure.
Which means?
It means some shares have more voting power than others. The founders, Vlad Tenev and Baiju Pat, they control the vote. As a common shareholder, you're just along for the ride. You don't really have a say in major corporate decisions. If you don't like the direction the company is going, your only real option is to sell your shares.
And speaking of selling, the insiders themselves are getting out.
That's a major concern for the bears. The co-founder, Baiju Pat, has sold 98% of his holdings.
98%. That's practically a full exit.
It is. And the CEO, Vlad Tenev, and other executives have been consistently selling under what are called 10b5-1 plans.
Okay, explain a 10b5-1 plan so we're all clear on what that is.
It's basically a prearranged plan to sell stock. It's a legal way for insiders to sell shares without being accused of trading on non-public information. They set it up months in advance, saying, I will sell X number of shares on this date.
Now, to be fair, founders sell stock all the time to diversify their wealth. It's normal.
It is normal. They can't buy a house with stock certificates. But when you see that level of selling 98% from a co-founder combined with a 9 times book valuation, it makes investors very nervous.
It begs the question, if they really believe the stock is going to $200 a share, why are they selling so much at 85?
It is a very valid question. If the captain of the ship is quietly lowering the lifeboats, you start to worry about the voyage, even if the band is still playing on deck.
And on top of that, there's the issue of stock-based compensation, or SBC.
Right. To attract top engineering and product talent, they pay a lot of it in stock. That creates dilution. They're constantly issuing new shares, which makes every existing share you own worth a teeny bit less.
But they have a buyback program, don't they? I thought I saw something about $1 billion.
They do, but the bears argue that the buyback is just treading water. They're basically buying back stock just to offset the new stock they're printing to pay their employees. It isn't actually reducing the overall share count as much as you'd hope.
So it's just stopping the dilution from getting worse.
It's like running in place on an escalator that's going down. You're working hard just to stay where you are.
Okay, so the bull says future of finance, and the bear says overvalued casino that's renting its customers. Let's look at what they're doing to try and fix that casino image. Section 4, the pivot to institutional and global markets.
This is their big attempt to escape the retail trap. They know they can't just rely on individual day traders forever. Their stated goal is to have 50% of their business come from institutions.
That seems ambitious for an app that started with a wait list for college kids. How are they even going to do that?
Bitstamp was the big move here, the acquisition of Bitstamp.
The crypto exchange, right?
Yes, but this wasn't just about buying an exchange to get more coins listed on their platform. This was about buying infrastructure, licenses, and relationships. Bitstamp has deep institutional roots in Europe.
How deep?
In the third quarter of 2025 alone, Bitstamp did $48 billion in crypto volume.
48 billion. Okay, that is serious volume. That's not just retail traders buying $50 of Bitcoin.
No, that is institutional flow. That's hedge funds, family offices, large crypto funds, and it allows Robinhood to serve that market. It helps them move away from the volatility of meme coins like Doge and Shiba Inu towards structural 24/7 crypto revenue that happens regardless of whether a meme is trending on Twitter.
So it makes the revenue quality higher and more predictable.
Exactly. And then what about Trade PMR? I saw that acquisition mentioned.
That's the other side of the coin. Trade PMR is a custodian for registered investment advisors, RIAs.
Financial advisors, exactly. Look, most really wealthy people with $5 million, $10 million, they often want a human to help manage their money. They aren't sitting around picking stocks on their phone while they're waiting for a coffee. By buying Trade PMR, Robinhood is basically saying to those advisors, hey, we can provide the back-end technology and custody for your clients. It allows them to touch the money of older, wealthier clients who would probably never download the Robinhood app themselves.
That's smart. It's like a backdoor into the high net worth market.
It's a huge maturity play. It diversifies them away from the fickle retail trader. And speaking of maturity, they've largely cleaned up their regulatory headaches. They finally settled with the SEC regarding their legacy crypto operations.
So that Wells notice overhang is gone now.
It is, and that removes a huge cloud of uncertainty that was hanging over the stock. Plus, they're now piloting tokenization in the EU stock tokens.
Stock tokens, so like a crypto token that represents a share of Apple stock.
Exactly. It allows for 24/7 trading and instant settlement on the blockchain. It's really the future of market structure, and they're testing it out in Europe, where the regulations are a bit friendlier right now. It positions them as a technology leader, not just another brokerage. They're helping build the rails of the next generation of finance.
Okay, so fundamentally, it seems like they're making all the right moves to mature the business. But we have to talk about the chart, Section 5, technical analysis. Because right now, the chart, it looks a bit ugly.
It's a battleground, no doubt about it. If you're a trader just looking at the charts, the trend right now is clearly bearish. The price is trading below both the 50-day and the 200-day moving averages.
And we mentioned the death cross earlier. It's like a heavy metal band, but what does it actually mean for the stock?
It's a well-known technical pattern. It happens when the short-term average, the 50-day moving average, crosses below the long-term average, the 200-day moving average. It signals that the momentum has shifted downward and that the long-term uptrend might be breaking.
Is it reliable, or is it just, astrology for traders?
Well, it works because people believe it works. It's a signal that trading algorithms and institutional traders watch very closely. So it often becomes a self-fulfilling prophecy. When the algos see a death cross, they sell, which pushes the price down even further. It usually means there's more selling pressure ahead.
But at the same time, looking at the RSI, the Relative Strength Index, it's at 14.
Which is extremely low. The RSI measures the speed and change of price movements. Anything below 30 is generally considered oversold. An RSI down at 14 implies that there's been some panic selling. It means the selling has been so intense and so fast that it might be overdone.
So is this a huge buying opportunity? Or is it a don't try to catch a falling knife situation?
That is the million-dollar question, isn't it? An RSI of 14 often triggers a bounce, a dead cat bounce, or at least a short-term snapback. If you believe the fundamental thesis that this is a $100 billion company in the making, then this could be a generational entry point.
You're buying when there's blood in the streets.
The technicals are screaming fear, and value investors often like to buy fear. As Warren Buffett famously says, be greedy when others are fearful.
So who is buying this fear right now?
ARK Invest, Cathie Wood. Her funds bought about $36 million worth of the stock just recently. She's famously a buyer of the dip on her high conviction names.
She loves her disruption plays.
She certainly does. And don't forget, another huge technical factor is that Robinhood was included in the S&P 500 index back in September of 2025.
Right. I forgot about that. That's a big deal.
It's huge because it forces all the passive index funds to hold the stock. Vanguard, BlackRock, State Street, if they run an S&P 500 fund, they have to buy Robinhood to match the index. That creates a permanent floor of demand that just didn't exist a few years ago.
It stabilizes the shareholder base.
It does. It means Robinhood is no longer just a speculative asset held by individuals. It's a core part of the retirement portfolios of millions of Americans, whether they know it or not.
And what about the sentiment on the street? Or rather, on the internet forums?
It's really shifted. If you go to Reddit now, on the investing forums, it's less about YOLO calls and rocket emojis and to the moon. It's more about yield harvesting.
Yield harvesting?
People are discussing the APY on their cash, the best strategies for the IRA match. It's more boring. But for a company trying to be a bank, boring is good. Boring is stable.
Boring is good. I never thought I'd hear that said about Robinhood. Okay, so let's wrap this all up. Section 6. The verdict. Advocate versus avoid.
Let's synthesize this. Put it all together.
Okay. The advocate stance. Why do I buy this stock today at $85?
You buy this if you believe in that super app vision. You look at the growth metrics, revenue up 52%, EPS positive, ARPU tripling. You look at that $5.4 billion cash pile protecting the downside. You see a company that is capturing the next generation of wealth. If you run a discounted cash flow analysis with even decent growth assumptions, you can get a target price right around $90.
So at 85, it's pretty much fair value for a great company with massive upside if they execute.
Exactly. You're betting on the management team to continue this incredible pivot they've built off.
And now the other side. The avoid stance. Why do I stay away?
You avoid, if you are a strict value investor, you look at 9 times book value and you just say there's absolutely no margin of safety here. You are paying for perfection.
So if anything goes wrong.
If growth slows, if a new regulation hits, if the Fed cuts rates and their NII drops, this stock could get cut in half and still not be cheap by traditional metrics. You argue that a brokerage is a commodity business and it shouldn't trade like a tech monopoly. You wait for a much lower price, maybe around $40 or $50, where the valuation starts to make sense as a financial firm, not a software firm.
So it really, really depends on what lens you're wearing when you look at it.
It absolutely does. My final thought on it is this. Robinhood has graduated. It went from being the bad boy of finance to a very promising professional, but the current price tag assumes they've already won the championship.
What's the one thing you were watching most closely? The key metric.
The churn rate on Gold members. Specifically, if they ever reduce that 3% IRA match, or if the market turns and that free money from high interest rates dries up, do the users stay? That is the true test of the business.
Is it a community or is it just a transaction?
That's the key question. Is it a cult or is it a coupon?
Exactly. If it's a cult, the stock is probably cheap right now. If it's just a coupon, the stock is probably very expensive.
Well said.
Well, here is my final provocative thought to leave you with. As AI, like their new Cortex tool, takes over more and more trading and research decisions, does the individual investor eventually become obsolete on their own platform? Are we moving toward a future where Robinhood is the trader and the user is just the capital source? If the AI is doing all the thinking, does it even matter if the interface is fun to use anymore?
That is a deep philosophical question for the future of all of fintech. It changes the whole relationship between the user and the app from being active participant to more of a passive limited partner. It really challenges the very mission of democratizing finance if the machine is the one doing all the work.
Something to mull over. Just a reminder for everyone listening. Full, deep value research reports can be found in the description links. All the analysis we discussed is based on publicly available sources and may be subject to revisions or differing interpretations. This content is for educational purposes only and does not constitute investment advice.
Always, always conduct your own due diligence before making any investment decisions.
If you want to listen to our full deep dive about this topic or access more advanced contents, you are welcome to join the Deep Value Club membership or subscribe to us on deepvalues.ai. And don't forget to like this video. It is much appreciated. Thanks for listening, and we will see you in the next deep dive.
Goodbye, everyone.